Hello and welcome to the Business Standard Morning Show. I am Ruchika Chitravanshi. It is 20th of December 2023 and here are the questions we will be answering today. Is India's funding winter thawing? Why is IT sector facing painful readjustments? Do IT stocks have more steam left? And what is the two-state solution?
Advancing data center performance and energy efficiency to solve your most important business challenges. AMD. Together, we advance.
Funding winter has never been so harsh. Indian startups received 72% less capital in 2023 than the last year. Weak global macros and a series of startup debacles have turned investors circumspect. But there are outliers too, the ones which have recently raised big ticket rounds. But how did they do it? And is there a thaw in sight? Shivam Tyagi brings you the answer.
The funding winter is increasingly getting intense. 2022 saw the birth of 23 unicorns. And this year, till the filing of this report, the country has seen the birth of just 2 unicorns. The year 2021 had seen 44 unicorns. The term unicorn is used to describe a startup company that is valued at $1 billion or more. The startup funding fell by 72% in 2023, with firms securing only $7 billion this year. Last year, it was $25 billion. In 2023, the late-stage funding took the biggest blow, dropping by 73%, closely followed by early-stage funding that sank by 70%, and seed stage falling by 60% compared to 2022. Seed fund is the very first stage of financing a startup. Early stage funds are raised for the purpose of supporting the development of a company's products or services, while the late stage subsumes Series C, private equity investments, and pre-IPO rounds.
One is there has been a rationalization that has happened across the industry. I believe there was a fair bit of irrational optimism that had prevailed in the late stage funding over the last, let's say, 3-4 years. And that has come to bear where corrections have happened. What it has done is it has separated the quality investments from some of the ones that are underperforming. The ones that have performed where there is a clear path to profitability or profitability already, where the competition has distanced itself from the other competitors, that is where you're seeing significant late-stage funding still coming through.
Okay.
And that's partially true across the board perpetually. However, in this case, because we had all that irrational optimism in the past, it's looking much more. I think the separation that has happened of quality companies from the ones that are lesser quality companies, that will continue to be there. So you will see that separation of late stage funding. Then again, 5 years out, would that change? Of course it can. But over the short term, and by a year, 2 years, I think we're going to see that discipline of late stage capital going in now.
As the expert pointed out, quality investments are still going on. Several startups secured reasonable deals in 2023, particularly in the late-stage rounds such as PhonePe, Lenskart, DMI Finance, Ola Electric, and Udaan, among others. While fintech, retail, and enterprise allocation remained the most funded sectors, investors also showed interest in the environment and space tech sectors. So exactly what does it take to attract capital?
It comes down to a few things. It comes down to positioning. Have you got the right positioning in the market? Have you got the ability to have unit cost profitability visible, where if either you have profitability or you're going to have a path to profitability which is pretty clear. I think those are important ones. And so the startups which have demonstrated that, those are the ones that are actually getting that late stage funding.
Venture capitalists are reportedly sitting on a huge cash pile worth $20 billion called dry powder. Experts claim these VCs are waiting for the interest rate to come down in the global markets, and they may loosen the purse strings, leading to revival in the funding ecosystem.
Overall consensus among the investors and among other ecosystem players is that the investors are super bullish on India for a long term. So things should improve, and it may not go back to 2021 levels, which was probably an aberration. But if you look at the funding trend today, it's less than $10 billion in, and so we are back to like a 2015-16 level. Our sense is that it should improve in the quarters to come, and we should go back to a pre-COVID level of about $15 to $20 billion.
Clearly, we may not see a repeat of 2021, but things are certainly looking up for startups as the global economy is on a recovery path. Going forward, vigilant investors and profit-driven scalable startups will be the new normal.
Global slowdown has also affected India's IT industry. Hiring in the sector has hit an all-time low, and salary hikes too are not as impressive as they used to be. Infosys recently announced its salary revision, which was less than 10%, and the IT giant didn't consider entry-level employees for salary hikes. So why is the IT sector facing this painful readjustment? Tariq Ahmed finds out.
Indian IT majors are some of the top employers of the country, with more than 1.7 million people on rolls as of December 2023. A generous benefits package is what attracted and retained top talents in the sector over the years. According to data from specialist staffing firm Xfino, the mid-level salaries in Indian IT firms have increased by 40 to 45% over the past decade. But that seems to be changing now. Major technology companies in India have either postponed or cancelled salary hikes for FY24 to protect margins. Global IT giant Accenture communicated via email to its employees that it would not be offering salary hikes to those based in India and Sri Lanka in 2023. In June, TCS delayed its increments by a quarter. HCL Tech has excluded mid and senior level employees from the current increment cycle. The picture is no different at Wipro. Infosys announced its increments this week with the average hike being less than 10%, where entry-level employees were not included in the hikes at all. In FY23, increments were comparatively lower than in previous years. At TCS, the raise for managerial positions also decreased significantly to 13.6% in FY23 from 27.4% in FY22. So why is the IT sector facing a painful readjustment?
Post-pandemic, the hiring that has happened was, the super cycles of digitization have made the industry very optimistic. There were some industry reports saying that the 5.5 million IT jobs is going to become 10 million or even more. So I think because of the overhiring that has happened post-pandemic, there's also a correction. Coupled to the macroeconomic conditions that are prevailing, plus economy is suffering, I think that has actually coupled to the trouble.
Employee cost remains the biggest outlay in the IT sector, contributing around 50 to 60% of total expenditure. According to Xfino data, leading IT companies have collectively raised compensation costs by 64% during the past 3 years, while total revenues grew by a little over 57%. This shows that input cost is much higher than the output generated. Demand slowdown around the world for IT services has affected the industry, triggering attempts to reduce employee cost. This is reflected in the salary hikes that job switchers are securing. According to Exfino's data, software firms are currently offering 18 to 22% hikes to job changers, a significant drop from the previous year's 40% raise in package. Speaking at the HCL Tech Q2 FY24 earnings conference, MD and CEO C. Vijay Kumar had acknowledged that the overall environment remains quite volatile. Every 2 to 3 months, the overall commentary is also changing, he had said. Top IT firms including TCS, Infosys and HCL Tech have also reduced their workforce by over 16,000 in Q2 FY24. The 4 leading Indian IT companies slashed a total of 38,950 jobs in H1 FY24. Hiring has sharply declined with a 69% drop in employee additions for the top 5 IT firms in FY23. They cumulatively added 83,906 employees compared to 273,377 in FY22. Amidst the lack of growth opportunities at IT, more than 2 dozens of senior IT executives have flocked to Big Four consultancies with better hikes. So how long will this condition prolong for the IT sector?
I think it's going to continue for some more time. It's very difficult to predict for how long this is going to continue, considering that all the predictions so far has gone wrong. So hopefully we should come out of this trough soon. But definitely we do expect that there's going to be huge amount of transformation in the jobs. And I think this is a time phase that the IT professionals should look at honing new skill sets, because this is one domain which is highly volatile, and this whole element of upskills is so much relevant for the IT sector, considering the way the skill sets keep changing, And we also know that how that artificial intelligence is going to impact most of the jobs and how most of the work is going to be around artificial intelligence. I think it's the time for people to develop those skill sets. So when the market is back in action, you are there, for those jobs. It should not happen that there are opportunities, but you are missing out because you don't have those skill sets which would be desired at that point of time.
Hiring overdrive during the pandemic has strained the IT sector, but experts believe that recovery is on the card. How FY25 pans out will depend on the deal wins in the second half of FY24. As the global economy continues to be uncertain and clients remain cautious on discretionary spends, the degrowth across the IT services industry will continue.
Advancing data center performance and energy efficiency to solve your most important business challenges. AMD. Together, we advance.
Meanwhile, IT stocks have been at the center of the Lal Street chatter since the Federal Reserve policy meeting last week. The United States Central Bank raised hopes of lower macro uncertainty in 2024 with 3 projected rate cuts. After the recent rally, Harshita Singh brings us the outlook for stocks ahead.
The recent rate cut forecasts by the US Federal Reserve fired up stocks of Indian IT majors last week. The Nifty IT index, which had remained an underperformer to the benchmark Nifty for 2023, is now holding higher gains after last week's rally. The Nifty IT index is up 25% for 2023, higher than an 18% gain in the Nifty 50. Over December 14 and 15, the IT pocket rallied as much as 8%, its biggest 2-day gain since July 2020. In the first 2 days of this week, however, the index has paused the rally on profit booking. The recent strength limits further upside in select stocks like HCL Tech and Persistent, says Kotak Institutional Equities, which has downgraded to 2 scrips. It has, however, raised target prices for the IT pack by 9 to 20%, as global headwinds are seen bottoming out amid rising hopes of a soft landing for the US economy.
The sector headwinds are clearly bottoming out, and gradually we'll see a earning recovery happening in FY25 and FY26 because the deals are still very strong, but closure of that deal and execution may be gradual going forward. But overall, I see the valuation in the large cap is still much more relatively reasonable as compared to some of the mid caps. So I believe that IT sector provide a good opportunity. If someone is willing to invest for next 2-3 years or 2-3 years, I think IT sector still provide a good opportunity for long-term investment.
Those at Kotak Institutional Equities also note that the gains in IT stocks this year have majorly been due to multiple re-ratings, even as FY24 and FY25 growth estimates declined in the same period. The brokerage's current forward growth estimates for FY26 are lower by 1 to 4% than its estimates for FY24, which were laid out 2 years ago at peak multiples. The valuations, it says, are approaching the peak levels of FY22. That said, from a short-term perspective, technical charts show the IT index can remain steady, ahead if it holds the 34,850 level.
The bias for Nifty IT index is likely to remain positive as long as it holds above 34,850 level. On the upside, the index will see fresh momentum on break above 36,550. Similarly, bias for Infi seems favorable above rupees 1520 with a potential upside target of rupees 1725. TCS is expected to get considerable support in the rupees 3680 to 3700 range, whereas near support for Wipro is seen at rupees 435, below which it can dip to rupees 420.
Thus, a recovery for global IT spending and gradual IT earnings is expected to begin from FY25, and experts favor the sector as a long-term bet. Today, on December 20, investors will keep an eye on crude oil prices and the consumer confidence data due in the US.
He's making plans for an early retirement. Business Standard.
Global financial markets may have priced in the Israel-Hamas war, but what if it escalated? That fear lingers on as casualties are rising on both sides. US President Joe Biden has called for a two-state solution to this vexed issue. But what is this two-state solution? Rimjim Singh explains.
As the death toll in the Israel-Hamas war started to mount, US President Joe Biden said in October that when this crisis is over, there has to be a vision of what comes next, and in our view, it has to be a two-state solution. Over a month later, a hard realization seems to have struck Biden. While addressing a campaign event last week, he said this is the most conservative government in Israel's history, and that the Israeli government is opposed to a two-state solution with the Palestinians. But it's the only solution that the world can think of right now. British Prime Minister Rishi Sunak has asked for it. The European Council and Pope Francis too think that a two-state solution is the way forward. India and China too want it. The two-state solution envisions an Israeli and a Palestinian state coexisting side by side. Hardliners from both sides have historically refused to accept this as a solution. While those in Israel want Palestinians to leave their lands and settle in neighboring Arab countries, those in Palestine didn't recognize Israel as a country till the signing of Oslo Accords in early 1990s. Under the Oslo Accords, Israel accepted the Palestine Liberation Organization. The PLO too recognized Israel's right to a peaceful existence. The two sides agreed that the PLO would govern the West Bank and Gaza, creating some hope of a roadmap towards two states. After World War I, the League of Nations granted Britain the mandate to govern Palestine. The Balfour Declaration in 1917 stated its support for a national home for the Jewish people in Palestine. Following this, Jewish immigration increased, which led to clashes between the Jewish and Arab communities. In 1947, the United Nations proposed a partition plan, under which it recommended creating separate Jewish and Arab states with an international administration for Jerusalem. The Jewish leadership accepted the plan, but the Arab states rejected it, which led to the Arab-Israeli War in 1948. In 1948, the first attempt at dividing the land led to an Israeli state but no Palestinian state, and the West Bank and Gaza Strip fell under Jordanian and Egyptian rule respectively. In the Six-Day War of 1967, Israel captured the West Bank, the Gaza Strip, and other Arab territories, which later led to the idea that Israel would exchange the captured land for peace with its Arab neighbors, including the Palestinians. Following the Arab-Israeli War, the United Nations Security Council unanimously passed Resolution 242, calling for Israeli withdrawal from the territories occupied during the war in exchange for termination of all claims or states of belligerency and acknowledgement of the sovereignty, territorial integrity, and political independence of every state in the area. The PLO strongly criticized the resolution, saying that it reduced the question of Palestine to a refugee problem. Efforts to negotiate a two-state solution intensified in the late 20th century. The Oslo Accords in the 1990s established the Palestinian Authority and outlined the transfer of power to the Palestinians. But there was no substantial progress in this regard due to ongoing violence over borders, refugees, and Jerusalem. Despite various peace initiatives, including the Camp David Summit in 2000 and the Annapolis Conference in 2007, an agreement has remained elusive.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
A senior Israeli lawyer whose opinion was sought by UK Foreign Secretary has said that close to 200,000 of the 700,000 Israeli settlers in the West Bank would have to be relocated to Israel to create a viable Palestinian state. Well, that's all we have for you today. For more news and analysis, please log on to business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.